The suggested work method proves to be helpful in identifying the differences for which we need consolidation journal entries. You start with the trial balance of the subsidiary. The subsidiary had a current year fair value adjustment through profit and loss for this investment property to measure it at a carrying amount of 150,000 Rand. But you have to perform this calculation from acquisition date in order to identify your differences. At acquisition date, the subsidiary did not account for the value adjustment, resulting in an at acquisition difference of 20,000 Rand when comparing the carrying amount of the investment property in the separate financial statements of S and that of the group. The moment the carrying amount on an asset is different, there will be a resultant knock-on effect in another line item the moment something happens to this asset. In this example, what happened to the asset was that the subsidiary had a fair value adjustment. But because they're working from different carrying amounts, the fair value adjustment has to be adjusted. The subsidiary had a fair value adjustment of 50,000 Rand. But in the group, because the carrying amount of the investment property has already been increased by 20,000 Rand, the fair value adjustment that the group can recognize in the 20x9 here can only be 30,000 Rand, which then identifies the other leg of the 20,000 Rand difference. Once the subsidiary has value adjusted the asset in its separate financial statements, that is also the correct value of this asset for group statement purposes, and you would not have any further differences. The consolidation journal entry for these differences would be as follows. At the end of 20x9, the first thing you always have to account for is this value adjustment at acquisition date that was not accounted for by the subsidiary. In this example, the fair value of the investment property increased, so I had to increase the equity of the subsidiary at acquisition date. I'm using the retained earnings account as I'm working with fair value adjustments on investment property. Remember, I'm only creating this equity item so that I have it available to eliminate through the at acquisition journal. The other leg of this journal depends on the line item in the subsidiary that's different from what I'd want it to be for group statement purposes. At the end of 20x9, it is the fair value adjustment through profit and loss of S that's different from what I want it to be. It's no longer the investment property, as this 150,000 Rand in the TB of S is also the correct value for group statement purposes. So the debit leg would be to the fair value adjustment of S through profit and loss. This journal entry changes the profit of the group and also the profit of the subsidiary included in the profit of the group. If I had to perform the consolidation of this group in 20x10 or any subsequent year, this journal entry would change to be as follows. You would still have to create that equity item or change the equity of the subsidiary at acquisition date, but now the debit would be retained earnings opening balance. The fair value adjustment of S has closed off to retained earnings opening balance in subsequent years. That now becomes the line item in S that's different from what I want it to be in the group. The effect on the at acquisition consolidation journal entry would now be as follows. The retained earnings that you eliminate would be the given retained earnings at acquisition of the subsidiary plus this 20,000 retained earnings that was created through the business combination valuation journal. If you do not create the 20,000 and eliminate that in the at acquisition journal entry, you would end up with incorrect goodwill in this example. In the consolidated statement of financial position at 31 December 20x9, I want you to see that the investment property of the subsidiary is added at 150,000 Rand and it's not changed for group statement purposes, as that's the correct value. In the consolidated statement of profit or loss and other comprehensive income for the year ended 20x9, the effect is a change to the profit of the group with this 20,000 Rand. In this example, the line item in the trial balance given was only profit for the year. Typically, you would adjust that 20,000 Rand in the line item where the subsidiary recognized the starting point amount being the 50,000 Rand. In this example, if you had to do a detailed statement of profit and loss, the 20,000 Rand adjustment would have been next to the line item other income. Because we were changing the equity of the subsidiary with the consolidation journal entries that we wrote in this example, the analysis of equity of S will have to be affected. At acquisition, the retained earnings of the subsidiary is no longer only the 7,500, but it now includes the 20,000 Rand which we've created with a consolidation journal entry. In the current reporting period, the profit of the subsidiary is the 110,000 Rand plus the 50,000. That is the combined TB profit of the subsidiary. And we changed the subsidiary's profit for purposes of changing the profit of the group. That's why the 20,000 Rand is considered in my calculation in the analysis before I have the amount that's allowed to be in the group. If I had NCI in this example, that 140,000 Rand would have been attributed to parent NCI. So the moment you had an equity consolidation journal entry changing the equity of S, NCI will be affected.